Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze FICO stock. FICO stands for the Fair Isaac Corporation. I'm going to talk about why I believe FICO is an outstanding company for long-term investing. As you may already know, FICO is the most widely used consumer credit score in North America. All the major banks and lenders need to use FICO scores to evaluate borrowers' creditworthiness before approving their loans, credit cards, and mortgage. As more consumers apply for mortgage, credit cards, and loans, FICO earns more revenue because lenders need to check borrowers' credit scores before underwriting any loans. This is why FICO has been performing exceptionally well over the years. In fact, FICO has significantly outperformed the S&P 500 over the past 5 years. However, right before I started making this video, FICO stock had dropped as much as 32%, mainly because the US Federal Housing Finance Agency FHFA Director Bill Post made several negative comments about FICO. Post said that he was not happy with FICO's pricing. He believes that FICO should be as economical as possible. To put it simply, he believes that FICO has increased its royalty fees too much in recent years. More importantly, his agency is looking to replace the current tri-merge credit report with an optional bi-merge credit report to reduce costs for both lenders and borrowers. Of course, if this happens, the biggest risk is that it may impact FICO's credit score volumes. Moreover, Donald Trump said that he is considering to privatize Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac have been under US government conservatorship after both companies almost collapsed during the 2008 financial crisis. If Fannie Mae and Freddie Mac were privatized, many investors worried that they might develop a competing credit scoring model or use the Vantage score model more instead of using FICO. Also, there's a lot of misinformation on social media that have recently impacted FICO stock. For example, in one post, this mortgage broker claimed that the cost of pulling credit reports has increased by 700% over the past several years, mainly because of FICO's dominance in the credit scoring market. This claim is misleading. FICO only charges $4.95 per score, which is one of the lowest costs in the entire mortgage financing process. FICO does not charge $80 for each credit report. Surprisingly, the FHFA director, Bill Poll, still acknowledged this post, even though there's a lot of misinformation. As a result, FICO stock dropped even further recently, partly because of a lot of misinformation on social media. So in this video, I'm going to explain why I believe FICO will eventually recover after this huge dip. I will explain why I believe FICO is one of the best companies for long-term investing. I will discuss these topics in this video. First, I will give you a quick stock portfolio update. Then I will talk about FICO's financials and outlook, FICO's monopoly in the credit score market, FICO's biggest risks to consider, FICO stock valuation, and whether I will buy more FICO stock going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members become multimillionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before diving into FICO, I want to talk about the current trade war. If you have been following my channel, you may remember that about a month ago, I predicted the market was near the bottom. I believed it would begin to recover because the US and other countries would eventually reach new trade agreements, and because Donald Trump would eventually ease his reciprocal tariffs. So far, that prediction has been correct. As long as the trade war continues to de-escalate, I believe the market will keep recovering. However, at the time of making this video, many trade negotiations have recently stalled. That's why Trump has started threatening China and the EU again. You have probably noticed this pattern by now. Trump likes to flip-flop on his trade policies almost every week. One week, he may ease his trade policies. The next week, he may threaten more tariffs and escalate the trade war with China, the EU, or other countries. Because of this ongoing flip-flopping, many investors have started following a strategy called the tackle trade, short for Trump always chickens out. Here's how it works. Whenever Trump threatens new tariffs and causes the market to drop, investors will buy the dip and wait for him to back off, which he often does. When he eventually eases his tariffs, the market always recovers very quickly. So many investors simply repeat this cycle, buying the dip during trade escalations and taking gains whenever Trump eases his tariffs. Personally, I'm not following this tackle trade strategy. I don't like to trade stocks. I prefer long-term investing much more than short-term trading, because the risk is much lower and because I can make much larger gains through long-term investing. Let me give you an example here. This portfolio is separated into 3 different accounts. In the first account, you can see that I have many multi-bagger stocks, including MasterCard, Visa, Microsoft, Amazon, and TSMC. I also have Meta, Google, and Nvidia in this account. All of them are the best and most profitable businesses in their industries. They are all near monopolies in their markets. I like to buy and hold the best companies for the long term, buy the dip whenever I have more cash, and let these outstanding companies become large multi-bagger stocks in the long run. The risk is much lower and the capital gain is much larger in the long run. This is the second account. The investing strategy is the same. I focus on buying and holding the best businesses. The best businesses are usually near monopolies in their markets. I like to buy their shares when they're undervalued and hold them for the long term, so they can become large multi-bagger stocks over time. I hold Visa, TSMC, Google, Microsoft, Nvidia, and Meta in this account. They are the best and most profitable businesses in their industries. I used to hold Apple in this account. At one point, Apple was an 11-bagger stock for me, but I have been selling it many times over the years and made around $100,000 from it. Recently, I sold my remaining Apple shares in this account. Then I withdrew some of the money and reinvested the rest into Nvidia, Meta, and other higher growth stocks. I believe Nvidia and Meta will have higher growth rates than Apple over the next 5 years. This is why I sold Apple. This is the third account. It's much newer than the 2 other accounts. This account has recovered a lot in recent weeks after Trump backed off and began de-escalating his trade war. Here you can see that I've invested in Meta, TSMC, Amazon, Microsoft, Nvidia, Broadcom, Google, ServiceNow, FICO, Apple, ASML, and AMD. Recently, I bought back some Apple and ASML shares because I still like both businesses and I believe both of them are still undervalued. I also started a new position in FICO after it dropped as much as 32%. FICO is rarely undervalued. Most of the time, it trades at a large premium. That's why I decided to buy the dip. I plan to hold it for the long term, so it can become a multi-bagger stock in the long run. Let me show you FICO's recent financials. I will explain why FICO has one of the best business models. First of all, we have to understand FICO's business model and why FICO is different from the 3 credit bureau companies, Equifax, Transunion, and Experian. FICO is a data analytics company that makes the FICO credit score model, which is widely used by 90% of the lenders and financial institutions in North America. FICO credit score is widely accepted by consumers in the US and Canada. FICO also provides analytics software and solutions to businesses, which help businesses make better decisions on credit risk, fraud detection, and customer management. FICO is different from the credit report companies. The 3 credit report companies, Equifax, Transunion, and Experian, are essentially repositories of credit information. They gather data from lenders and other creditors about how individuals use credit, including payment history, account balances, and inquiries. This information is compiled into a credit report, which is a detailed record of an individual's credit history. On the other hand, FICO develops and licenses the algorithms used to calculate credit scores. These scores are then used by lenders and other institutions to assess an individual's credit risk. FICO scores are based on information within the credit reports provided by companies like Equifax, Experian, and Transunion. They use this data to determine a numerical score that represents an individual's creditworthiness. Now, to put it simply, credit bureau companies collect each individual's credit data, such as the number of loans, past payment history, credit limit, outstanding loan amount, recent inquiries, and credit utilization. Then FICO will use the information in each credit report to create the FICO credit score. It's nearly impossible to replace FICO and use another credit score system because FICO is widely used by 90% of the major lenders in North America and is widely accepted by consumers and investors. Let's take a look at FICO's financials. FICO has two major revenue sources, FICO Scores and FICO Software. According to the most recent financial report, FICO Scores contributed about 60% of the company's total revenue, while FICO Software contributed about 37%. FICO is exceptionally profitable. Very few businesses have operating margins as high as FICO's. For example, in the most recent quarter, FICO Scores segment had an operating margin of 89%, which is exceptionally high. In comparison, FICO Software segment had an operating margin of 31%, which is still quite strong. Overall, the company's total operating margin was 58%. This shows that FICO is exceptionally profitable. FICO Scores contribute the majority of the company's operating income each year. More importantly, the Scores business segment tends to grow faster than the Software business segment. For instance, in the recent quarter, FICO Scores segment grew 25% year-over-year, while the Software segment grew by only 2% year-over-year. You might be wondering, why is FICO Scores business growing faster than its Software business? There are two main reasons. First, FICO Scores business has significant pricing power because it is essentially a near monopoly in the credit scoring market. FICO can gradually increase its revenue each year by raising its royalty fee per score. For example, back in 2018, FICO's royalty fee was around 50 cents to 60 cents per score. In late 2023, it had risen to about $3.50 per score. More recently, FICO's royalty fee increased again from $3.50 to $4.95 per score, which is a 41% increase. Based on what I know, these royalty fee increases have been the biggest growth driver for FICO in recent years. Second, FICO's credit scoring business is largely tied to the volume of loans, mortgage, and credit cards that originate each year. As long as lending activity, especially mortgage origination, continues to grow in North America, FICO will earn more royalty fees because lenders are required to pull borrowers' credit scores whenever borrowers apply for a mortgage, credit card, or personal loan. That's why FICO's revenue and operating income have consistently grown over the past 10 plus years. FICO's earnings per share and free cash flow per share have also been growing consistently over the years. Here's my prediction. I believe FICO's revenue and earnings will continue to grow steadily for many years because of FICO's strong pricing power and because the volume of mortgage, credit cards, and loans in North America will continue to increase over time. As I mentioned earlier, FICO's business is exceptionally profitable. At the time of making this video, FICO's latest TTM gross margin is around 81%. Its operating margin is around 44%, and its free cash flow margin is around 38%. This is why FICO stock is always traded at a large premium most of the time. Over the years, FICO has returned most of its free cash flow to shareholders through share buybacks because the company's credit scoring business and its software business require very little capital or capex to grow. According to the recent earnings call, FICO's management said that the company will continue to buy back shares regularly every year, even if the stock is pricey. But here's a potential risk to consider. At the time of making this video, FICO has approximately $192 million in cash and long-term investments. In comparison, its total debt stands at around $2.55 billion. This means FICO's net debt is around $2.36 billion. FICO's debt to EBITDA ratio is relatively high at around 3. This is because the company has taken on a lot of debt to buy back shares in recent years. That said, I believe FICO's debt level is still manageable because FICO has very high margins and the company consistently generates strong free cash flow every year. FICO also requires very little capital to grow every year. This is my prediction. Going forward, I believe FICO will likely need to use its free cash flow to pay down its debt and slow down its regular stock buybacks so that its debt to EBITDA will be lower. In terms of outlook, management expects that the company's value to grow to approximately $1.98 billion this year, up from $1.72 billion last year. This suggests a projected revenue growth of 15% year-over-year. Management also expects EPS to reach around $25.05 this year, compared to $20.45 per share last year. This indicates an expected EPS growth of approximately 22% year-over-year. Over the longer term, analysts estimate that FICO's revenue will grow by around 15% or slightly higher annually over the next 4 years. Since most of FICO's operating costs are fixed, the company should be able to expand its margins over time. This is why FICO's EPS is expected to grow even faster at an annual rate in the 20% range over the next 4 years. I believe these long-term growth estimates are reasonable because FICO has enormous pricing power. The company has a near monopoly in the credit scoring market in North America. Now let's talk about FICO's biggest risk to consider and its near monopoly in the credit scoring market. Here's my prediction. First, over the long term, I believe FICO's credit scoring business will continue to perform very well because of its significant competitive advantage called network effects. FICO holds a near monopoly in the credit scoring market. As I mentioned earlier, it's nearly impossible to disrupt this business. The FICO score is used by 90% of major lenders and financial institutions in North America, and it's also widely accepted by consumers and investors. Many investors do not know this. When banks want to securitize mortgage and sell them to Fannie Mae, Freddie Mac, or institutional investors, which is a common practice to replenish liquidity for banks, banks are required to provide FICO scores. These scores help assess the risk of the underlying mortgage loans so that Fannie Mae and Freddie Mac can repackage them into mortgage-backed securities or MBS. This makes FICO scores essential in both the mortgage origination and mortgage securitization markets. So in short, FICO is trusted and widely accepted by consumers, lenders, and institutional investors. Second, I believe the volume of mortgage loans, credit cards, and auto loans will continue to grow over time in North America. This is because most consumers rely on credit to buy their homes and vehicles. FICO earns value whenever a lender pulls a borrower's credit report. This means FICO's value and earnings will continue to grow over time as lending activity, especially mortgage origination, grows in North America. Third, as I talked about earlier, FICO has strong pricing power because of its near monopoly in the credit scoring market. FICO will gradually increase its royalty fee per score over time. This means we can expect that FICO's revenue, earnings per share, and free cash flow per share will continue to grow higher over time. Fourth, FICO continues to innovate and improve its credit scoring models to better predict borrowers' credit risk. At the time of making this video, FICO's latest models are FICO 10 and FICO 10T. FICO will eventually release its upcoming FICO 11 scoring model. I believe these new and improved scoring models should justify the company's raising its royalty fees over time. Now, FICO does have other competitors, the biggest being the Vantage score model, which was developed in 2006 by the three major credit bureaus, Equifax, Transunion, and Experian. Based on what I know, most credit reports use both FICO and Vantage score models. The Vantage score model has been around since 2006, but FICO still dominates the market and is used by 90% of the top lenders and financial institutions. Moreover, FICO scores are widely accepted by consumers and investors. I think this shows that it's nearly impossible to replace FICO, even if Equifax Transunion, Experian, Fannie Mae, and Freddie Mac try to compete and develop their own credit scoring models. Of course, regulators don't like monopolies, so we need to consider the potential risk that may impact FICO. At this moment, I believe there are three major risks to keep in mind. First, as I mentioned earlier, FHFA Director Bill Pott has proposed to allow lenders to use a 2 credit bureau format instead of the current 3 credit bureau format. This means lenders can use credit data from just 2 of the 3 major credit bureaus, rather than all 3. Based on my understanding, the purpose of this change is to help reduce credit report costs for lenders. Of course, if lenders start using a bi-merge credit report instead of the current tri-merge credit report, it may reduce FICO's credit score volume and revenue. However, this change is expected to be optional and is not a mandatory requirement for all lenders. Here's the important part you should know. I believe most lenders will continue to use the tri-merge credit report rather than switching to a bi-merge credit report. That's because lenders prefer to see borrowers' credit data from all 3 major credit bureaus, Equifax, Transunion, and Experian, and not just 2 credit bureaus. Each bureau has slightly different credit info for each borrower, and having a complete credit profile across all 3 bureaus helps lenders better assess risk. Using a tri-merge report can reduce credit risk for lenders and in turn lower overall borrowing costs for borrowers. Typically, a tri-merge credit report costs between $80 and $100. That's relatively not expensive at all compared to other closing costs such as appraisal fees, broker commissions, underwriting fees, and legal costs, which can add up to thousands of dollars. So let's consider this trade-off. If lenders switch to the proposed bi-merge report, they can save money on each credit report, but it increases the credit risk for lenders and ultimately raises borrowing costs for consumers. In the long run, saving more money on a bi-merge report is not worth the added credit risk for most lenders. Here's the second risk we should consider. Regulators, such as the U.S. Federal Housing Finance Agency, FHFA, are concerned about FICO's near monopoly in the credit scoring market and its significant pricing power. The main issue is that FICO has increased its royalty fees substantially since 2018. For example, between 2018 and late 2023, FICO raised its royalty fee from around 50 cents per score to $3.50. More recently, the fee was increased again from $3.50 to $4.95 per score, which is a 41% jump. This is why the FHFA is considering allowing lenders to use a bi-merge credit report instead of the current tri-merge format. This is to help reduce credit report costs for lenders. Of course, many mortgage brokers have been complaining that they are overpaying for each credit report. They believe that FICO has increased its fees too much over the years. In reality, other closing costs such as appraisal fees, broker commissions, and solicitor costs are much higher than credit report and FICO fees. Typically, a mortgage broker can earn anywhere from $1,000 to several $1,000s from each mortgage, depending on the loan amount, interest rate, and the fees charged to clients. These commissions are far greater than the cost of a tri-merge credit report, which is usually around $80 to $100. Here's another example. At the time of making this video, FICO charged $4.95 per score. In comparison, the average total closing cost for buying a home is around $6,000. This means FICO's royalty fee accounts for much less than 1% of the total closing cost. So even if FICO has significant pricing power, I don't think regulators can force FICO to lower its royalty fee per score. This is because other home closing costs, such as appraisal fees, broker commissions, and solicitor fees are significantly higher than credit report costs and FICO's royalty fees. Here's the third risk we should consider. As I mentioned earlier, Trump and the U.S. Federal Housing Finance Agency, FHFA, have considered the possibility of privatizing Fannie Mae and Freddie Mac again. If that happens, investors are concerned that Fannie Mae and Freddie Mac may develop their own credit scoring system, use the competing Vantage score model more, or reduce their reliance on FICO. Of course, these concerns are based on speculations. The market always overreacts to any potential negative news or regulatory change. Here's my prediction. Even if Fannie Mae and Freddie Mac were privatized, I believe they will continue using FICO scores. FICO remains the industry standard for evaluating mortgage borrowers' credit risk and is used by 90% of major lenders in North America. FICO scores are widely used in the mortgage lending and mortgage securitization markets. Investors who buy mortgage-backed securities or MBS from Fannie Mae and Freddie Mac often rely on FICO scores to assess the credit quality of these securities. If Fannie Mae and Freddie Mac use a different credit scoring model or use FICO less, investors will demand higher yields on mortgage-backed securities, which will ultimately increase the borrowing costs for borrowers in the mortgage market. Of course, the U.S. Federal Housing Finance Agency does not want borrowing costs to increase for consumers. That's why I don't think Fannie Mae and Freddie Mac will use FICO less even if they are privatized. Let me show you this consensus forecast from Seeking Alpha so you can see FICO's expected growth rates going forward. Over the next few years, FICO's revenue is projected to grow by approximately 15% to 16% annually. After that, FICO's revenue growth is expected to slow down to around 10% to 11% per year. If I had to make an educated guess, I believe FICO's revenue can grow by around 14% to 15% annually over the next 5 years, mainly because of FICO's strong pricing power. In terms of EPS forecast, FICO's EPS is expected to grow even faster at an annual rate in the 20% range over the next several years. I believe these EPS growth forecasts are reasonable because FICO's operating expenses are largely fixed. FICO does not require much capital to grow. This makes it easier for the company to expand its margins and drive higher EPS growth over the next 5 years. Let's take a look at FICO's valuation. There are several ways to value FICO stock to see if it's undervalued, fairly valued, or overvalued. One common method is to look at FICO's forward PE and its expected EPS growth rates over the next 2 to 3 years. If you look at FICO's TTM PE, it's definitely not a cheap stock at all. Historically, FICO's PE has consistently remained above 50 during normal market conditions over the past 5 years. Since investing is forward-looking instead of backward-looking, it's more important to focus on FICO's forward PE and projected EPS growth. By the end of this fiscal year, which ends in September, FICO's forward PE is expected to decrease to around 59. This forward PE is still relatively high, even though its EPS is expected to grow by around 23% this year. Looking ahead to the next fiscal year, FICO's forward PE is projected to drop to around 47. I think this forward PE is more reasonable because FICO's EPS is expected to grow by around 24% next year. Overall, I believe these forward PEs suggest that FICO is still slightly overvalued at the time of making this video. Here's another way to value FICO stock. Right now, I'm building this investing app with a friend. We plan to launch it later this year once we have fixed most of the bugs and improved the user interface. We have created this algorithm that can calculate the fair value of most stocks. This fair value algorithm helps us find out whether a stock is likely undervalued, fairly valued, or overvalued now. Here's how it works. There are 3 key values to focus on: our fair value estimate and the 2 price targets. The orange line represents FICO's fair value over time. The blue line shows its actual share price, and the dotted lines are price targets. At the time of making this video, FICO is trading slightly below its fair value. Based on our estimate, FICO's fair value is approximately $1,930 per share. The average analyst price target is much higher at around $2,421 per share. Just to compare, our own price target is much more conservative at around $1,768 per share. After considering these 3 values, I believe FICO is currently slightly undervalued. Full disclosure, I bought the dip after FICO dropped as much as 32% recently. I also calculated FICO's intrinsic value using this intrinsic value model. I always use this intrinsic value model to calculate each stock's intrinsic value so I will know whether a stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define FICO's intrinsic value as its future free cash flows discounted to the present day. I use a discount rate of 9.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the expected growth rates I talked about earlier, I believe FICO's value will grow at a compound annual growth rate or a CAGR between 13% and 15% each year over the next 5 years. My base case scenario is that FICO's value will grow around 14% annually over the next 5 years. I used a long-term growth rate of 7.5% to calculate the terminal value. Over the next several years, I believe FICO's free cash flow margin will improve slightly over time. Let's go over these 3 case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that FICO's value will grow at a CAGR of 13% each year over the next 5 years. Then FICO's intrinsic value should be around $41 billion for the entire company, or $1,645 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that FICO's value will grow at a CAGR of 14% each year over the next 5 years. Then FICO's intrinsic value should be around $42 billion for the entire company, or $1,721 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that FICO's value will grow at a CAGR of 15% each year over the next 5 years. Then FICO's intrinsic value should be around $44 billion for the entire company, or $1,800 per share. I'm giving this scenario a 25% probability here. If you add all these numbers here, FICO's intrinsic value should be around $1,722 per share. I also use a forward sales ratio model to estimate FICO's intrinsic value, which should be around $42 billion for the entire company, or $1,708 per share. If we calculate the average of both ratio models, I believe FICO's intrinsic value should be around $1,715 per share. If we consider all the valuation models, including the investing app I showed you earlier, I believe FICO is either fairly valued or slightly undervalued now. So will I buy FICO stock? Yes, I plan to buy more FICO shares whenever the stock trades below its intrinsic value. FICO is rarely undervalued. It typically trades at a large premium, so I plan to wait for a large dip before adding to my FICO position. I like FICO's credit scoring business. It's essentially a near monopoly. FICO scores are used by 90% of lenders in North America and are widely trusted by both consumers and investors. FICO also has exceptionally strong pricing power. This allows the company to gradually raise its royalty fee per score. This will allow the company to earn higher revenues and earnings over time. I believe the volume of mortgage, auto loans, and credit cards will continue to grow over time, which will help increase FICO's credit scoring value. Here's my prediction. I don't believe Equifax, Transunion, Experian, Fannie Mae, and Freddie Mac will be able to reduce FICO's dominance in the credit scoring market. They have tried using the Vantage score model, but FICO still remains the industry leader. I also think most lenders will still use the tri-merge credit report instead of the proposed bi-merge credit report, because the tri-merge credit report helps lenders reduce credit risk while decreasing borrowing costs for consumers. Now, all these are only my opinions and my analysis that's based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.